All right, great. Everyone, this is Erik Thompson. He is the founder of Peerless Wealth, a wealth management firm in Ohio, and also the portfolio manager of the Wheel ETF, which could be one of the first and only Wheel ETFs out there right now. So, Erik, welcome to the show, and thanks for speaking with me and my audience. Tell us just a little bit about yourself and what you usually do to introduce yourself to an audience or new clients.
Sure. Thanks for having me, and thanks for everyone for listening. I'm calling from Columbus, Ohio. My background is as a retail financial advisor, helping folks that have money that just want a coach and someone to help them make good decisions about it and manage it for them, whether they're in retirement or working on retirement. And so, in doing that, a lot of advisors just kind of use firm models or just don't really get into the weeds with investments. They kind of just go manage relationships, whereas I really liked getting into the weeds on investments, and I'll talk about the ETF here in a bit. But I just turned 50, and I've been doing this 26 years, and started pretty much right out of college, uh, cold calling and knocking on doors, and eventually built up a client base and spent time at Edward Jones and Wells Fargo, and then started Peerless Wealth in 2019. We manage money for primarily high net worth individuals and families, some corporations, and we're a fee only firm, meaning no commissions or annuities or things like that. And about half my clients are retired, and so there's always been a desire for most of them to create income, and there's a lot of different ways you can do that in retirement. Some are just fine with selling principal. Some use annuities. I like actually just living off the income. I think that's the way I plan to do it when I retire. And we see these Monte Carlo simulations in our world. If you take a 4 or 5% withdrawal, you have a 87% chance or whatever it is. But if you just live on the income and you do it responsibly, then I think it's 100% chance. And so that's kind of what we're shooting for. And in really, I didn't use a lot of option strategies for the majority of my career. I stuck to fairly plain vanilla investments, but I would say starting about 6 years ago, maybe sooner. But when we got down to ultra low interest rates, what really drove me to study options was not from the speculating side, buying calls, to speculate on the upside or trying to time downturns and buy the puts. And that side of the options doesn't work incredibly well unless you do it very carefully. But I was more interested in creating income for my clients in a period where interest rates were nothing. You had a group of retirees that they might have had a fairly typical portfolio. Maybe it was 60% stocks, 40% bonds, or somewhere close to that. And again, this was 5 years ago, maybe 6 years ago, and I'm looking at the 40% that was in bonds, and it was treasury yields were like 2%. And I've been doing this long enough that I know that when interest rates go up, bonds lose value. We got a painful reminder of that in 2022. There's a lot of individual investors and unfortunately some advisors that don't even understand that bond math. And so I was looking at that 40% of the portfolio, that very best case that makes 2%. And there was a base case that it would probably lose, like it just if rates went up a little bit. So I started looking at a lot of the kind of buffer and hedging strategies using options, structured notes, that sort of thing, and started working that in to kind of replace a portion of the typical client's fixed income, and you know used ETFs and mutual funds for some of it, but for a certain number of clients that had more capital to work with, we would do that manually. And the method that we really liked is what we call the wheel strategy, which and this isn't on, when I use an option-based strategy like wheel, it might be for 10 to 20% of the client's, total. There's no perfect investment. Every investment has, sort of pros and cons. And so this wheel strategy, it's a bit different in now we didn't invent the term option wheel. If you Google or YouTube it, you'll see, home gamers and even some professionals that will show you sort of their version of a wheel. You can run an aggressive wheel. You can do it on one stock. You can do it on SPY. You can do it on what we do, which are primarily sector-based ETFs. Um, but it's a methodology that I'll show you in a minute. I have an illustration. But the difference with the wheel strategy is it incorporates cash secured puts. And there's been so many option income strategies that have been launched in the past 5 years or so that the vast majority are some version of a covered call strategy.
Hmm.
And a cash secured put is really the same type of math and the same type of return framework where you're sort of capping your upside. But if you get assignment on the stock, you'll own it and then you'll have the downside. And I'm convinced that the reason there's not more products that use cash secured puts is I think investors and even advisors have a hard time understanding it. I think it's a lot of behavioral finance. I think they hear the term cash secured put and their head spins. Whereas a covered call is a very familiar strategy for people. They own the stock. Let's just juice the income a little bit. We're capped on the upside. It makes sense, sort of intuitively and logically, whereas cash secured put doesn't. And I can prove that this is the case in that one of the few strategies that offered that kind of used a put selling or put writing strategy was from Wisdom Tree. I think it launched, I don't know, 7, 8, 9 years ago. It was called something basic like the Wisdom Tree Put Right ETF. And the returns were good. Never really caught on. The assets, I think, were maybe 50 million after 5, 6 years. And I was looking for it the other day because I run comparisons, against our product, and I couldn't find it. And I found out they changed the ticker. They did not change the underlying strategy. They still sell puts. They changed the name to something like the Wisdom Tree Equity Premium Income Strategy.
Mm.
Do you understand the marketing ring that has versus the Wisdom Tree Put Right?
Yeah.
It shouldn't be this way, but that's why. Because if you can do a lot of research, writing puts, there's a lot of research that says for the same risk, strike price, expiry, security, it's actually a little bit more profitable than writing calls because behavioral finance has proven that investors, they hate to lose more than they like to win. The other way of saying that is the pain of loss is greater than the satisfaction of win. And so what that we know this because over a long period of time for the same given security, the same given strike expiry, on average, puts go for a little bit more than calls because people are willing to pay when they're buying a put. We're selling it, but when they're buying a put, they're willing to pay more for protection than they are willing to pay for speculating on the upside.
Hmm.
And we're selling them that protection. So we and so there's more moving parts than a typical covered call strategy. I think it's another reason why maybe it hasn't really caught on. We could, in theory, be 100% long like a covered call fund, or we could be 100% in cash writing puts. We're normally somewhere in between. And I think sometimes that's hard for people that are very stringent on their asset allocation. What is it? Where, at any given time. So I think maybe for those reasons, but we did file for a patent on it because we're the only one that's ever packaged the wheel as a 40 Act public product. And one thing I'll add before I stop talking for a minute is that it's very expensive to run an option wheel strategy manually. And for example, if you're going to write one put contract on the Qs. The Qs are 600 or whatever they are, 600 something. It's cash secured, so you need the cash there in case it fills. That's the conservative way to write a put. You need $60,000 for one contract on one ticker. And you'll know by the end of this call that I'm not a fan. I think most of these strategies are too narrow in their underlying. We believe in full, broad diversification, so we use many tickers to hit all the different asset classes. It lowers our risk profile quite a bit. So you add IWM, you add the GDX that we're doing, some of all the other ones, and you need 300-400 grand to do this manually. And remember, this isn't a core strategy like having SPY for half your account. You're not going to own this. Maybe 10, 20, possibly 30% of your account with you can see how it would be out of reach for a typical investor that even did have the wherewithal up here to do it. Maybe they don't have the capital. And I think the ETF makes a lot of sense with this type of strategy. So that's the background. I can go into the wheel, or you can ask some other stuff
Yeah.
if you want.
No, that's great, and that's a good point because I think a lot of people will have, like you said, a bucket of their portfolio that's focused on growth and another that's focused on income. But if you only have a, $500,000 portfolio, you can't write puts on the cues without being very concentrated in them.
Yeah,
So that's
yeah,
a excellent point. And I did want to point out, if people haven't seen Erik's website, he's got testimonials from clients, and you had like a retired math teacher that had like a $2 million portfolio. So I'm just curious, is that like your typical client, or who is your
yeah.
typical
It
client?
is. It's a lot of sort of everyday millionaires. I have some eight-figure clients, right? But most of them are, maybe they worked at Procter and Gamble for 35 years and they got their 401k and maybe pension and maybe their extra savings. I have pilots as clients, attorneys, doctors. Now, to clarify, there's two websites. There's Peerless Wealth, which is my RIA, and then there's Peerless ETFs. For most of the people here, they're probably going to want to go to the ETF website if they just
Yeah.
want to delve more into the product. I'm considering having a link on the Peerless Wealth site to the ETF. That's added to my to-do list. But um, we don't at Peerless Wealth, we use primarily until we launched our own product. It would all be third-party ETFs. From the big guys, BlackRock, Vanguard, some smaller players too. Uh, we just thought that this wheel strategy was better than the other strategies out there. We really liked the put writing, and we couldn't do it for more than a handful of clients because we do weekly expiries, which is a lot of work.
Mhm.
Um, and you can't go through 50 accounts every Monday morning and make 10 trades. By the time you get to the last guy, it's 3 p.m. and he or she has gotten totally different pricing, and it's just um, so the ETF made a lot of sense for our practice, so that everybody could uh, could get the same strategy, large or small, and we could do it in an efficient manner. And my co-manager Rob, who is my partner here on the ETF, we both were like, if it's good enough for our clients, let's go ahead and get it out there and start talking it up to other folks. And it, it we're small. We don't plan on launching 20 different ETFs. I think the market's pretty saturated with product right now. Um, you'll hear in a minute. I'm not a fan of the single stock ETFs and a lot of uh, these crazy yield products, and I'll tell you why in a few minutes. But this was something that's not out there, and we're and but it's catching on. We have a lot of other advisory firms like mine that have started to use it for their clients. There's individual investors as well, but I would say, and we just launched a year and a half ago, and comparatively we're small. We're just shy of 30 million. Um, but it's starting to catch on, and we hired another person to help with it, and we're committed to growing it. But I'll get into this wheel strategy. I'm going to share my screen.
Yeah,
Um,
let's definitely get into it. And at some point, if you could talk about how you choose the underlying holdings within
yeah, I
the
will.
Wheel ETF, I'd love to hear about that.
Is this showing up? The sort of
Yeah,
the
I
okay.
can see it.
So that's me. That's Rob. Uh, this is going to be a significantly lower risk profile than I didn't look at all your videos. I looked at a couple, but there was obviously a lot on the what is it?
Oh,
ULTY.
Ulti. Yeah, the
Yeah,
Yield Max Ulti fund.
yeah. And my position on these products is that I don't want them to add risk to the portfolio for my typical client, and they should provide income and lower risk. Maybe they add risk to the bond part, but they if a retiree or any investor, let's say they normally are 60% stocks, 40% bonds, I might take 10% out of stocks and 10% out of bonds and put it in something like this. Because our risk is going to be right in between. The problem with this category, which is derivative income, that's the Morningstar category that's proliferated over the last couple of years. I did a little bit of research before this call because I was curious. When I look at, there are 120 derivative income ETFs that have been around at least a year. And I'm going to start with a whole nother category just for comparisons. There are 50 corporate bond ETFs. Okay, very boring category, right? Corporate bonds, you might get 5%. They're bonds, right? Um, but out of those 50 corporate bond ETFs, I ranked them from the top performer over the last 12 months to the bottom. The top performer was 9.58%, best out of 50. The worst performer, dead last, was 2.5%.
Hmm.
The dispersion there is not that great, right? Because
Right.
it's corporate bonds, right? It's just like it's a pretty stable asset class. I did the same thing for large cap blend equity funds. So this is your S&P 500 and all the actively managed ETFs that are in that category. There were about 300 of those. The very best was one I haven't even heard of, SAMT Strategies. It was up 33%. Bear in mind the S&P was up about 17, 18 last year. The very worst was for something called GGM Macro. Again, never heard of it. It was plus 1%. So you had plus 1 to 33, no negatives. That was large cap core. Now let me move to derivative income for the last year. The very best performer was, it appears to be a single stock, PLTY, Planeteer Single Stock Covered Call Fund. It's probably Yield Max, uh, up 77%. The very worst, MSTY, which is MicroStrategy Single Stock Covered Call Fund, down 42%. So you go from negative 42 to plus 72. It's such a huge dispersion in this derivative income category that it really warrants education. And hopefully I can help provide some of that. Um, so we and so I'll give you a couple features here in this top left box. We don't use individual stocks. Our underlying investments are all broad-based and sector optionable ETFs. Now, we could make this much simpler and just run the wheel on something like SPY. And me and Rob's life would be a lot easier. But we know that wouldn't work as well. SPY doesn't give us a lot of option juice. Whereas if we break apart the sectors of SPY into financials and techs and REITs and materials, we use GDX, then we get a lot more option premium, but we're still very diversified. And I'll go into that a little bit more later because I know that was one of your questions. I personally think most of the products in this category are too narrow of an underlying. And I'll give you an example because they're a couple of the biggest. JP Morgan, they have JEP-E and JEP-Q. And JEP-Q, the underlying is the Qs. JEP-E, the underlying is primarily a large value strategy. Well, the Qs, JEP-Q did a ton better last year because of its underlying. Because large value struggled a little bit comparatively, was barely up, whereas the Qs were still hot. But go back to 2022 and it reversed, and JEP-E did a lot better than JEP-Q. Well, why mess with all that? Why should we, in our opinion, let's just have one derivative income fund that hits all of that because it smooths out the ups and downs. You don't get whipsawed around. Um, we don't need markets to go up to make money. I'll go into that in a minute. I talked about this one on the top. Sorry, here. The one on the top right was we only sell. This is derivative income. We don't buy puts. We don't buy calls. There's other products that do that. Yeah, that's in a whole other Morningstar category called options trading. But derivative income is to the point of income. Seeks income without the duration risk in most fixed income. I spoke to that earlier. Bonds have duration risk. We don't have that. What you'll see when you look at our top holdings is you'll often see a lot in short-term treasury bonds, and that serves as collateral for our put writing. So it
Mhm.
gets confusing, but I'll explain that in just a minute. Uh, in my opinion, the main reason to do a I'll call it a responsible derivative income strategy is this bottom middle box, which is if we get into a long-term range bound type of market or what I said I've been doing this for like 25 years. I got my Series 7 license in late 98. Didn't really start doing much with it till 99. I didn't know it at the time, but 99 to 2009 was a lost decade for the S&P 500. A lost decades where the market doesn't do anything for 10 years. We had the 2001 tech bubble burst, dot-com bubble burst. '02 was the trade centers that got hit. We had 3 down years in a row for the S&P. We came back, we got to new highs. Then '08, '09 came along with the financial crisis. We went back down again. There was a 10-year period of time where you made no money. And as you know, the S&P doesn't pay much of a dividend, so that's not going to help you much. Well, there's been a few other lost decades over the last 80 or 90 years. They all have one thing in common. They start in periods of high valuations where PE ratios are higher than average. And I'm going to skip to a slide on this because this is one of my favorites, and it's busy, but I'm going to talk through it with you. And yes, it's a year old, 12/31/24. You see the S&P 25.2 times earnings, but today it's like 26. So it's not much, maybe 27. So the PE ratio is probably the most common measure to value equities. If the stock market doubles over 10 years, but earnings double, that's fine. You're not getting overvalued. It's when the price goes up, but the earnings aren't going up quick enough. That's when you get the bubble and you get this PE ratio expanding. In 1999, it was 27 times earnings, and that was the only time it was higher than it is today. And what do we get? We get a lost decade. Now, I've never been a negative pessimist, but I would never to just tell people to sit on the sidelines because no. But what you need to do is be mindful of valuation. And the S&P, just as an index, has done great over 10 years, but we started at much lower PE ratios 10 years ago than we do now. And what this chart shows is rolling 10-year periods of time and their average annual rates of return based on starting valuation. So let me give you an example. when the S&P 500 starts at low valuations, like 15 times earnings, historical average, by the way, is about 17, 18. When it starts at low valuations, your next 10 years, measured by the blue box, is a pretty good 10-year period. Average annual returns are up into the teens, certainly north of 10%, which is, because you started at cheap valuations. Now, valuations like price earnings ratios are a horrible predictor of the next 5 or 10 months because there's so many other factors. But over the next 5 or 10 years, they actually are a very good indicator. They're just not going to necessarily make you happy in a short run prediction. What you see is an obvious trend in these blue dots. The higher the starting price earnings ratio gets, the lower your subsequent year average annual return decades are. Does that make sense?
Yeah, so the bottom right, the dots that are to the right of the green line and under the green box, those are the returns that you got after a high valuation. Is that right?
Yes. And
Okay.
their average annual returns, and you can see they're actually negative.
Yeah.
Now, I don't believe this analysis counts dividends. And so I think you can probably add a couple percent to these, and these here would be mostly along the 0% line instead of like -2 or 3. But those are your lost decades.
Hmm.
And so what did well from 99 to '09? Well, the S&P was arguably it was overvalued in 99. Didn't do that great, lost decade. Small caps did pretty good because they were cheap in 99. Real estate investments did really well. Emerging markets did pretty good. Option income strategies did well. Now, there weren't many around back then, but there's data on, had you done those strategies? Because what we're doing with covered calls and cash secured puts is we're saying, I'm going to get some extra income now, but I'm going to cap my gain. And if the gains don't come because, let's say, because of high valuations, that's a really good trade-off, right? In a roaring bull market, that's usually not a good trade-off because you'd make a lot more on the capital gains. So in periods where the viewers that are watching, I would put myself in this camp, at least for the S&P, if we think we're maybe a little frothy on the valuations, maybe getting a 10 to 12% yield, max. It's not good if you make 17, 20%, but if you're not going to make that, then that's a really good trade-off. That's where I believe these products work. But I feel like I think there's a lot of kind of just hokey products out there. We believe in responsible yield. We pay 12%. We started at $20 a share in May 2024 when we launched. We're still at $20 a share, maybe a little higher, 20.3, something like that. And we've paid a 60-cent dividend every quarter. We've paid a couple ones that are higher than that because at year end, as a regulated 40 Act fund, we have to pay out all our income. So you
Yeah.
typically get the bigger one in the quarter. Yes, we theoretically could go monthly. The reason why we don't is because uh, we believe we won't be able to collect quite as much income over the course of the year. Because if we have to pay a dividend every month, then we have to be out of the market for a couple, 2, 3 days. We can't use the cash to write the puts, and that cuts into a little bit of the option income. So plus it gives us the ability to smooth out the dividends so that if we have one month that we create more and one month we create less, your income's not bouncing around. Uh, Now, what is the wheel? Here's the wheel. This is on our website. Uh, the top of the wheel, number one, we start with a cash secured put. Now, this gets confusing, but every one of the tickers that I mentioned, like the Qs, IWMs, GDX, XLE for energy, we kind of go on down the line. We're doing an independent wheel on each one of those and managing them all simultaneously. Okay. But the concept of the wheel is instead of just buying the stock and writing a covered call, we start with number one, which is write a cash secured put. What is that? Well, we're going to sell a put that's out of the money. Okay, so let's say it's $100 per share on whatever ticker we're using. We do them weekly because we think weekly math is very compelling for total return. Let's say we write the 97 strike. That's out of the money. That means we have a buffer, a cushion against the initial loss. We have 3% in that case. Usually we get a 2 to 5% weekly cushion. So we won't participate in that initial loss. If whatever ticker we're doing this on goes down for the week past the 97, in my example, we're totally okay with that. Let's say it finishes at 95. We miss the first 3 points of the drop. We get to buy it at a discount, at a 3% discount from where it started the week. We're down 2, so we're down a little bit. Let's say that. Now, if that doesn't happen, it stays above 97. We just stay up here at the top right, and every week we just keep writing new puts. And by cash secured, when you write it, when you sell or write a put, if it finishes below the strike price, you are required to buy it. And it's called what's called taking assignment. And you need to come up with cash to do that. If you don't have the cash in your brokerage account, it's considered a naked put. And I joke with my partner, some things are great naked, but put writing is not one of them.
Yeah.
So we always do what are called cash secured puts. We have the cash, we assume it's going to fill, even though usually it doesn't. Now, when I say cash, we use T-bills. We don't go any riskier than that. It's all 1 and 2 month T-bills. That's why you see a lot of T-bills in our top 10 holdings, because it might be needed if that share price drops. So let's say it drops, it finishes at 95. Now we go ahead and we take assignment. We're on step 2. We own the shares long. Now what we do is we sell a call on those shares. So now it's a covered call position. And let's say we get assigned at 97. Let's say it starts the week at 95. We're down $2. We're going to go ahead and write a call. We will probably put the strike price right back at 97 where we got it assigned. We like to get back to even. What that does is it prevents long-term NAV erosion. What a lot of these covered call funds have trouble with is, and this is the knock on the strategy in general, is that you get 100% of the downside and none of the upside. If you write them too close to the money or at the money, that's true. Now you get a lot of income, but that income doesn't always offset it. And what happens is on a lot of these ETFs is that the price drops. Sure, you get the income, but in a real down market, the income doesn't mean much because the income's annualized, and the down market can be really sharp over a few weeks. So it goes down. Then the manager, in an effort to keep that distribution yield high, keeps writing calls, and he's got to go closer to the money. Then the shares rebound, and he gets called away too early. He doesn't participate in the rebound. We wait till it gets back to even before it gets called away. Okay, so that's kind of, and then now we may stay down here and own that name for a few weeks. It could be down here for a few months. We got assigned to Energy, XLE and OIH. I don't know. I think it was last December, and we finally got that back called away just recently. But we get income 3 ways. We get put income, we get treasury bond income, and then if, assuming it gets assigned, we get call income. Plus, if we own the name and it pays a dividend, we get dividend incomes, but it's not much. So at least 3 ways. That's how we get our yield. And we actually, when we write the puts, we usually aim for about 15% annualized. Plus, we get our T-bills of maybe 4. That adds up to close to 20. We probably won't make much more than about 20%, even in our best years. Last year, we made almost 8, I think between 17 and 18. um, uh, which for our risk profile was very good. We have a beta of 0.65. I don't know how much your listeners are familiar with some of the basic terms, but beta, the S&P has a beta of 1. That's the benchmark. If something has a beta of 2, it's twice as volatile. If something has a beta of zero point 0.5, it's half as volatile. So we have a beta of 0.65. So uh, we're quite we're a lot less volatile. And this little thing, we're probably gonna we tell investors in a strong, quick bull market, we will likely lag. Uh, in a flat market, will be great because of that yield. In a slightly up market, we'll do great, but maybe not. We'll probably do better than something like a typical stock fund. In a slightly down market, we may, because we have that buffer every week, if we get a slow, drawn out decline, we may not lose much at all. If we get a super fast decline, like the tariff thing last year, we only miss that first few percent of loss. Then we're in it, but we're not gonna. I think the S&P dropped about 20% during that time. We were down like 16, 17, because we only missed that first few percent buffer. But we're not going to be down any more than if you just owned all of these long. We don't take any leverage. The portfolio and the allocation, if I were to, this is Morningstar, if I were to plug it all into Morningstar, this kind of shows uh, we are by design a little underweighted technology and a little extra in we kind of have a value tilt, and we have a little bit more in things like energy and materials. Materials, we use GDX, which is gold mining, and we have some emerging markets. Those areas, energy, emerging markets, and gold. Now, this past year's weird. Both stocks and gold went up, but typically gold is all three of those areas are very low correlation to the S&P 500. So what we're doing here, every one of these optionable ETFs that we're doing the wheel on, we're getting high income on all of them, responsibly high. We don't want to get in this downward spiral like a lot of these really high yield ones do. We're but we do it with sectors that don't all move together. So the end result is a more stable NAV. And just to give you a little bit of an idea, today's one day, but it's not uncommon. Uh, the uh, the Magnificent Seven went down 1.5% today, and we were actually up 5 basis points, basically flat.
Mhm.
The S&P was down 50 basis points. We were flat, and it has to do with this process. And we feel like 12% is responsible when you start getting into these products. And I did a brief analysis on you did so many videos on UTLI that launched about the same time we did a few months before, and uh, and we've beaten it. I think it was basically flat when even if you reinvested all your income. But what I did is I looked at the holdings of it, very aggressive, popular stocks that command very high option premium. And but is it working? And I would say no. If when it launched, I think from launch to the end of last year, almost 2 years. I can send you this offline, but it was up about 8% in total return with dividends, about 8%. If you would have just bought the shares of all the underlying and owned them long, you would have made something like 135%.
Yeah, I mean, Ulti does trade a lot, so like the underlying holdings now
Right,
are
they're
not the same
different,
at the
different.
beginning.
What I think what a lot of these the real high yield product providers have done is they've taken a good thing and gone too far with it. Um, I don't know the appropriate analogy. Maybe it's like caffeine, right? You have a cup of coffee in the morning, it's not going to hurt you. And you get up a little bit, it's good. Maybe you could have 2 cups, you're fine. But if you're drinking coffee all day or it leads to like, harder drugs, then it's going to backfire.
Yeah.
And having writing at the money calls on a super volatile security, volatile means both ways. You don't get any of the upside because it's at the money. It's like driving a Ferrari and getting pulled over and hitting a stoplight every couple blocks, right? Versus someone in a Honda just going 40 miles an hour and just eventually getting ahead. So it has a ton of horsepower, but it doesn't work because you constantly get pulled over and slow down. So I'm not. I would rather just own, like for my own clients. I would rather just like owning maybe the triple Qs or a good growth fund and just leave it long. And this stuff to me it should be lower beta and closer to a bond fund, more risk, but as opposed to uh, so anyway, our performance is down here.
Oh,
The up.
I had stopped your sharing so they could
Oh,
see it. Did you
sorry.
want to go back and share?
Yeah, I'll do it real briefly. The uh, uh, This is as of 11:30. We do have the updated one on the website, but it hasn't made it over this to presentation yet. Um, Last year we finished between 17 and 18. Um, and you can see kind of the average annual return since inception. Don't ask too much of this category. It's really uh, so much of it's based on your underlying. If you don't understand your underlying, you don't do these. Like and I think that it should be super diversified. We write puts and calls, so we kind of what we feel is the appropriate benchmark is a 50% BXM versus 50% uh, put writing, but you could also compare it to the just the buy rate, which is covered call. So we went. So last year's a good year. I mean, up 17%, beta of 0.65, and a yield of 12. There's not too many products with those sort of characteristics. So let's see if I had anything else I wanted to share. Those were the main things. We're the sub advisors, so we use Title Financial as the service provider, and they're technically the advisor. They service a lot of big ETFs. SoFi actually YieldMax uses them.
Yeah.
So all of the board of directors, the compliance, the legal, the market making, the website, the returns, they do all of that minutia so that Rob and I can just focus on managing the strategy. I will say that with any ETF, especially the small and mid-sized ones, um, be careful of the bid-ask spread when you're buying and use limit orders, even if your limit order is just at the ask, which is probably what you'll end up paying or pretty close. We're usually about 5 or 6 cents on the bid-ask spread. You'll probably play closer to the ask. We're not one that you're going to want to trade in and out. This is just not you're not going to be happy over time if you use this as like a tactical thing. This is okay, I'm worried about high valuations. I want to position 5, 10, 20% of my account for a lost decade, collect that yield, leave it alone. And I'm not just saying that so we collect fees and that sort of thing. It really, especially with bid ask spreads, if you try to dividend time any of these products or get in and out of them, you're probably not gonna. It's not a very good strategy over time.
Yeah, that's a fair point, especially for the lower volume, less liquid
Yeah, yeah,
ones. I did notice that you guys, I think your largest equity position, if I'm looking at this, is the ARK Innovation ETF.
yeah,
So can you speak to why that is and why
yeah.
I'm guessing you're bullish on that.
No, here's what's
No?
weird.
Okay.
So I should say we are bullish on it as a wheel strategy. Okay.
Okay.
Um, Starting when I did in '99, I've been programmed to be sort of very concerned with high price earnings ratios. That's always been, we all are sort of shaped by our experiences, and I've always been cautious about buying something like a Planeteer or something that's literally like 400 times earnings, or maybe they don't even have any earnings, right? And it's the valuation is I was mindful of that. So and the manager of our Kathy Wood is about growth. She doesn't really care much about valuation. But here's the thing with ARC. So I don't think I'd ever buy it on my own and just hold it long, right? Because of sort of my slightly value biased, especially now. But the stocks within ARC, Tesla, Coinbase, Robinhood, they very similar to like a UTLY. They command very high option premiums. Remember, we use wheel as a verb. We're wheeling the strategy. Okay,
Mhm.
we're gonna buy it after a dip. We never buy at the high because we're writing out of the money puts. So we're collecting put income. We're buying on a dip. Then we're writing calls on it. And the puts and calls on ARC give us, out of all of the tickers, give us the most option premium. It's the most aggressive. It probably will get called away this week. I think we got it at 83 or 84. And it's 80, I think we got it 84. It's 83.20 right now. So if
Yeah.
it could get called away, but it's actually been really good to us. When we were doing it in client accounts before the ETF, there was a year where ARC actually went down in value, but we made money on it by wheeling it because we never bought at the highs and sold at the lows.
Okay.
Good question though, because that is a little bit counter to some of the other things I've said, but that one gives us a lot of option juice.
Sure, sure. And I do the wheel myself. Um, I usually, when I sell a cash secured put, am choosing something that's like a point 0.2 delta or 20 delta
Yeah,
and an
yeah,
80% chance of profit. Where are you guys? How far
very
below?
similar.
Okay.
We are usually a 15 to 20 delta when we're writing the put, which gives us, and these are weekly, remember. So
Yeah.
that gives us, depending on the ticker, a 2 to 5% buffer. Like ARC, we can get like 5% cushions and still get, and actually the delta is much lower. But there's higher risk in that if we do get it assigned, now we have a riskier group of names. So we have to keep that in mind. This is why we don't use individual stocks, because with an individual, we're capped on the upside. When we're writing puts, we're capped on that upside. So stock picking and finding something that makes 60% in a year doesn't help us because we're capped on that upside. So in our view, we need to be hypersensitive on the downside because we have that full downside if we own it. And we don't want to get caught with like a United Healthcare, right? Remember what that did last year, right? Big
Mm.
blue chip company. It was down like 40% or something like that. I just had a client that they own some Progressive with massive insurance company, but they're down like 30% last year. We don't want to get assigned the name and it keep falling. Now, could that happen with an ETF? Yes, but we're eliminating single stock risk, so the odds of it going down and staying down are way, way less.
Okay. And you mentioned that you're doing weeklies. Are you rolling the positions on Fridays?
The puts we always let expire.
Okay.
Okay. If we get and we just renew the trades on Monday, it's week is such a short time, we're not going to close early. But sometimes on the call side, the put side is very regimented, very rules based. We kind of just went over it. On the call side, um, if we write a put on $100 ticker with a 97 strike and it finishes the week at 96.75, that'd be like perfect. Then we
Juicy.
come into Monday and it only needs to make a quarter point to get called away. We're going to get massive call premium and our delta is going to be way higher. But we'll get back to even, right? And that's fine. And then we'll just keep rinsing and repeating. or it could keep dropping down, like energy, for example. It dropped far enough to where we weren't getting much on the calls, even if we went a month out, especially if we wanted to get back to even because it had gone down so much. So we just stopped writing calls, which
Oh,
again, if we paid weekly or monthly and we were so focused on yield, we would have to keep writing calls down low. Then we would have got called away early and missed this big rally in the oil. So we're not afraid to stop writing calls. We'd much rather get that rebound on the share price than a few extra bucks, not share price dollars, but literally dollars, in writing getting 2 cents for some call that might get called away. So the call's a little bit more of an art, the put's a lot more of a science.
okay, that makes sense. Let's say that you get assigned at like $99 on a Friday,
Hmm.
and the stock on Monday then moves up to like 105 or something for whatever reason.
Yeah.
Would you still sell at the strike price you were assigned, the
No, we would
$99?
probably just sell at market.
Okay.
Now, your question about rolling, I forgot to answer it. We have done that lately with some of the calls because as of today, I think we are, if you look at all the tickers we do wheel on and you add them all together, about two-thirds of the portfolio is in the top of the wheel, which we're in that cash secured put writing mode. And that makes sense because we're near all-time market highs, right? We just haven't gotten assigned anything. There's been some things, ARC was one of them, might get called away. Energy, we actually wrote calls and it was coming close to the strike to get back to even. And we elected to roll them and increase the strike. And that we did that. So we kind of broke our rule, but we did that because we don't own much long right now. We're like 35% long. And so there's not a lot of risk in the portfolio right now. And we don't want to lag too much by not being, long a few things. So sometimes we roll the calls.
Okay. And for my audience, let's say that they're a, income focused investor and they're evaluating something like JEPI or the
Hmm.
NEOS fund SPYI,
Yeah.
and they're comparing it to your fund. How are these like competitors, or do they
Yeah.
complement each
I know
other?
them. I know them. I used to use JEPI before we created our own. Uh, both good products. They're cheaper than us. We're small. We're at 99 basis points. Uh, we're really at 84 basis points, but we have to pass on the underlying expenses of the ETFs if we get assigned them, right? Because they have some expenses and
Mhm.
we have to kind of pass those on. So it's a bit maybe a bit lower, and we hope to lower that over time as assets climb. But we've proven ourselves. We've done better than both JEPI and JEPQ last year. We've done better than both of those with a lower beta and a higher yield. Uh, and here's what I'll say. Again, I think they're too narrow in their underlyings. Um, one's got pretty much all the underlyings in large value. The others got pretty much everything in the Qs. Where's the small cap? Where's the emerging markets? Where's the gold? Where's the REITs, right? These are all areas that professionals would tell any long investor to own over the long term. So why not write options on the same things? It just it that's what we're a lower risk profile than uh, both of those. JEPI's pretty low because they do it on very low volatility stocks, uh, but we have I think they're 8% yield, we're 12%. So
Okay, cool. And these are just going to be some quick questions, maybe even like a speed round, because I want to, get as much information
sure.
as well. And these are probably going to be easy, but just so that we have it on record. One is, does your fund use any leverage or any
No,
borrowing at all?
no,
Okay, cool. Number two, people are concerned about NAV erosion and receiving their own money back, return of capital. How do
no.
you explain the income? Yeah.
It's all option premium and treasury bill interest.
Okay.
No
Great.
return of premium.
Great. What is the tax classification of this
So
income?
it's going to be taxed like ordinary income. So you're better off owning it in an IRA if you have a choice. That said, there's plenty of people that own CDs and corporate bonds and are fine to pay taxes on it. And we're taxed just like they are, and they own them in taxable accounts. But if you have a choice, maybe overweight the IRA.
Okay, great. And then you mentioned the beta as being lower than the S&P. So
Mhm.
I guess if the S&P were to go down, 1%, how would you expect your fund to respond?
So this is where it gets a little tricky because you could have a day like today where the S&P went down 53 basis points. We went up 5 basis points.
Mhm.
There's other days where the S&P might drop, say 1%. You would expect at a 0.65 beta, if they drop 10%, we drop 6.5. That said, and that's just share price, right? Maybe we get some income to offset that. But that said, the speed of the drop is relevant. A slow, drawn out drop, we might drop it all, not drop at all. Today, the S&P is very concentrated in Mag 7. Mag 7 was down quite a bit. The other areas weren't down nearly as much. We don't have a lot in tech and Mag 7. So there's a couple factors there.
Okay, cool. And I just want to talk about some of the underlying holdings because, like you said, if people think that they're going to go into a lost decade and they don't want to be concentrated in the Mag 7 because
Hmm.
they're in SPY or VU. So here
Yeah,
are just some of the holdings. The wheel has, as we mentioned, ARK, a utilities ETF, a China internet ETF,
yeah,
real estate, um, iShares home construction. Is that
yeah.
okay? VanEck and oil services ETF. So that's like gas oil companies.
Yeah, that's your Halliburtons and your Transoceans. Yeah, not XLE, which you might mention next. That's your Exxon and your Chevrons.
Yeah. And then oh yeah, there's XLE. And then you also have the VIX ETF as well. So
Yeah,
it's not a large holding, it's less than 1%, but
right.
why is that included in the
So
wheel?
again, it helps. We it's optionable. It gives us that income we like, but it's actually negatively correlated, as you knew, to the S&P. So again, if we can get 10 to 20% income on this wheel, but we can put assets together that don't all go up and down at the same time. Remember, they all go up at the same time. We're capped on what we're going to make anyway. So
Mhm.
why not protect more of the downside? The way to do that, now we don't own bonds. It's kind of dumb to write options on bonds. There's just like no juice there. But writing them on the VIX for a small portion, just because over time the VIX will not go up. Like whereas everything else in the portfolio, long term, even a sector ETF will, given it long enough, will go up over time. You can't really say that about the VIX. That's why we have it in such small amounts, but it is a nice little hedge.
Okay. And then it looks like you've got a lot of T-bills in there with interest rates potentially declining this year. Does that mean you'll try to add more spokes of the wheel or positions?
No, I don't think so. If anything, we might be a little less in the amount of tickers. Some of these overlap a little bit, but uh, the T-bills are used. There's more T-bills typically near market highs because we've gotten called away and we're sitting at that top of the wheel. And you see different tranches because we're doing weeklies. So these things, the timing, right? We have to buy these things. Some we might have bought a couple weeks ago, some we might have just bought. We tend to stick to 1 to 2 month. We could get more yield if we went to 10-year T-bills, but then we would bring in duration risk on our collateral. Our collateral, we want as close to cash as possible. If rates drop, then uh, we'll get a little bit less on our T-bills.
Yeah.
All else being the same, we might average 50% T-bills over the course of the year. So if we got 1% lower in T-bills than what we were a year ago, that equates to maybe 50 basis points less on the entire fund because we're not in 100% of the accounts not in T-bills. If volatility goes up, that will create more option premium for us, especially on the put side. When stocks drop, they say volatility goes up when stocks drop. That means people are really wanting puts. They're really clamoring for protection and they overpay. We're selling that to them. That's what's great about being able to sell puts.
Yeah.
When there's a bull market, we get a little bit more on the calls. So
And I just wanted to also mention that you guys, it looks like you have puts on the GDX and SLV, which is
yeah,
iShares Silver ETF as well. Did you want to speak to why you've
yes,
done that?
smaller on the silver because so what we basically do is we break the S&P apart into the sectors. Materials is one of the sectors. Now, there is a material ETF, XLB, I think. Uh, but the gold miners are also in that group. And the GDX is very liquid. It gives great option premiums. And gold, maybe not so much these last 6 months, but gold is usually not heavily correlated to the S&P. So that's why we use GDX. Silver, I think we target something like 7% exposure to GDX, but now we're doing like 5 to GDX and 2 to silver. Silver's got some hella premium right now because there's just both, even on the put side. I expected it on the call side because it's had such a run. But on the put side, but we're doing such short. I think we got like 14% cushion on silver for the week. Like it would have to drop 14% to get assigned.
Yeah, that's
So
huge, but
that's a
possible.
little bit more speculative and a bit in the VIX camp, but that's why it's such a small position, but it gives us some good juice.
Yeah, no, I'm selling those puts as well. I do know that SLV has like a Wednesday expiration as well, in addition to, Friday
Okay.
ones. You could trade it a couple days.
Yes, one thing too, we have a most of the portfolio is Monday through Friday weekly, but then we have a portion that we do Wednesday to Wednesday. I
Hmm.
think IWM and QQQs because those are ones, and that just gives us time diversification so that not everything's sort of expiring the same time.
I think that's really smart. So that's great to hear. One other thing I noticed for the viewers that's important is that you personally hold, I think over like $1 million
Yeah,
in
I do.
Wheel yourself.
Yeah.
Um, how important is Wheel to you for your personal income?
So I that's probably split between an IRA account and a taxable account. So I pay the taxes on it. Um, the return profile to me, and it's less than 20, it's probably 20% of my investable assets. So I still own a blend of large cap growth. I've owned Google, Microsoft, Apple forever. I own some other blue chips like JP Morgan and John Deere and so forth. And then I own some index funds. I like the fundamentally weighted ones, but my long portfolio is probably it moves eerily close to the S&P 500. Then I have probably 10% in small caps. I think those are overlooked, especially by the younger generation, because small caps really haven't done much in the last 5 or 10 years to large, but they're much cheaper. And then I have about 5% in REITs, which the same thing in emerging markets also I own. But yeah, I think having, for me, maybe around 20% of my investable assets in something that I feel like it'll make 12%. Like I'm very confident we can't guarantee anything, but based on the fact that I run the strategy, I see how it works, and I'm not using single stocks and so forth. Um, it'll it'll go below $20 here and there, but 5 years from now, 10 years from now, I expect it to be still right around $20. And if I can get 12%, I don't think the S&P is going to do that on average the next 12 years, just based on starting valuations. It might, and it's not going to do zero. It could do somewhere in between. I think small caps could do that, and so I view it as that lost decade protection. That's my personal use for it, and what my typical client use for it is.
Fantastic. Okay. Well, that pretty much wraps up all my questions, Erik. Thanks so much for
Mhm.
taking the time to explain the wheel strategy or the wheel ETF and the wheel strategy and your picks. Any last things you want to leave my audience with?
Uh, I think I covered everything I want to cover. And just want to thank everyone for tuning in. And if you do become a shareholder, I really appreciate it.
Okay, cool. And maybe down the line we could do a catch-up call in case any of my audience watches this and has
Sure.
questions about wheel that they want to
Yeah,
ask
and
you.
if you go on our site, there's a email that is monitored. And feel if you have questions, Rob and I do monitor that. So feel free.
Great. Awesome. Okay, I'll pause the recording there.